You've been taking depreciation deductions for years, but the IRS is waiting to tax every dollar of it back at 25% the moment you sell. This is Brick and Dollar Research, and today we're breaking down one of the most misunderstood and dangerous tax traps in real estate investing: depreciation recapture. Most investors know depreciation is good. It reduces your taxable income, lowers your tax bill, and puts cash back in your pocket every year. But here's what gets left out of the conversation. The IRS doesn't forget, it's collecting interest. And when you sell that property, the bill comes due, sometimes for tens of thousands of dollars in taxes you didn't budget for. Let's start with the basics, because understanding depreciation is crucial before we can understand why recapture is so dangerous. Depreciation is an accounting concept that says buildings, and certain building components, lose value over time due to wear and tear. The IRS allows you to deduct this theoretical loss from your taxable income, even though you might not have actually spent any cash. This is what makes depreciation so attractive to real estate investors. Here's a concrete example. Let's say you buy a rental property for $400,000. The land is worth $100,000 and the building is worth $300,000. Under IRS rules, residential rental properties are depreciated over 5 years. That means you can deduct $300,000 divided by 5 years, or approximately $10,909 per year in depreciation. Now let's walk through what happens over time. Year 1, you deduct $10,909. Your taxable income from that property drops by $10,909, saving you money on your tax bill. In year 2, you deduct another $10,909. Over 10 years of ownership, you've deducted approximately $109,090 in depreciation, even though you haven't spent a dime on this deduction. It's purely on paper. Meanwhile, the actual market value of your property might have increased. Let's say your property is now worth $500,000. That's $100,000 in appreciation, real wealth creation. You've saved tens of thousands in taxes through depreciation deductions, and your property has appreciated $100,000. Everything feels great, but here's where the tax trap springs. When you sell that property for $500,000, the IRS says, "We know you deducted $109,090 in depreciation. We're going to tax every single dollar of that back to you at a rate of 25%. This is Section 1250 recapture tax, and it applies to real property used in a trade or business. So in our example, you'd owe $109,090 times 0. 25 equals $27,272.50 in depreciation recapture taxes. That's on top of your capital gains tax, but it gets worse when you factor in capital gains. Let's complete the math. You bought for $400,000 and sold for $500,000, so your capital gain is $100,000. Your long-term capital gains tax rate depends on your income bracket, but let's assume 15%, the middle bracket. That's another $15,000 in taxes, so in total you're paying $27,272.50 depreciation recapture plus $15,000 capital gains equals $42,272.50 in federal taxes, and that's before state taxes, which could add another 10–15% depending on where you live. This is exactly why depreciation recapture is dangerous. Investors take the deductions happily for years, but fail to budget for the substantial tax bill that arrives at sale time. Many investors are shocked when they realize they need to set aside 25–40% of their profit just for taxes. Now, let's talk about a critical misconception: the myth that depreciation recapture doesn't apply if your property appreciated. This is false, and it's a dangerous belief. Here's why: depreciation recapture is a tax on the deductions you took, not on the actual depreciation of the building. The IRS is essentially saying, "We let you deduct this amount when you owned the property. Now we're collecting it back." Whether your property went up, down, or stayed the same in value is irrelevant. Let's look at a counterexample to illustrate this point. Imagine another investor buys the same property for $400,000 and holds it for 10 years, deducting $109,090 in depreciation. But during that 10-year period, the real estate market crashes. The property is now worth only $350,000. They sell at a loss. You might think, great, they won't owe depreciation recapture because the property went down in value. You'd be wrong. They still owe the full $27,272.50 in depreciation recapture taxes on the $109,090 they deducted. In fact, their situation is even worse because they also have a capital loss of $50,000, which they can only deduct $3,000 of per year against other income. They'd owe recapture taxes on a property sale where they actually lost money. This is one of the most painful scenarios for real estate investors, and it happens more often than people realize, especially in cyclical markets. Let's examine a real-world case study to make this concrete. Case study: the landlord who forgot to plan meets Sarah, a real estate investor in California. In 2012, she purchased a duplex for $600,000, $150,000 in land value and $450,000 in building value. She immediately began depreciating it over 5 years, taking $16,363 per year in depreciation deductions. For 10 years, 2012-2022, Sarah deducted approximately $163,636 in depreciation. This saved her roughly $50,000-$60,000 in income taxes. Depending on her bracket and state taxes, she was delighted with her investment strategy. In 2022, the property had appreciated to $750,000 and $150,000 gain. Sarah decided to sell and reinvest in a different market. She felt financially successful. Here's what Sarah owed. 1. Depreciation recapture, $163,636 times 0, 25 equals $40,992. Long-term capital gains tax federal 15% bracket, $750,000, $600,000 times 0, 15 equals $22,503. California state income tax 9, 3% bracket, $750,000, $600,000 times 0, 0.93 plus $163,636 times 0, 0.93 equals $14,050 plus $15, 218 equals $29, 268 total federal taxes, $40,909 plus $22, 500 equals $63,409 total with state taxes, $63,409 plus $29, 268 equals $92, 677. Sarah had calculated her after-tax profit as roughly $150,000, the appreciation. But instead of netting $150,000, she only netted $57,323. Her true profit margin was cut by 62%. Worse, if she had lived in a higher tax state like New York or New Jersey, her total tax bill could have exceeded $110,000. Now let's talk about how depreciation recapture is calculated, because the specifics matter. Depreciation recapture is taxed at a maximum rate of 25% under Section 1250 of the Internal Revenue Code. However, most investors think of 25% recapture, when actually the recapture is taxed at your ordinary income tax rate, capped at 25%. For high-income investors in the 37% bracket, this can be favorable. For lower-income investors, it's less favorable because it's taxed at their ordinary rate, which might be 24%, 32%, or 35%, but the recapture itself is a real tax bill. The calculation is straightforward. Total depreciation deductions taken times tax rate up to 25% equals depreciation recapture tax, but there's a nuance. Different types of real property have different depreciation schedules. Residential rental property, 27. 5 years commercial property, 39 years personal property appliances, furniture, 5-7 years personal property depreciation, sometimes called bonus depreciation or Section 179 depreciation, is recaptured at your ordinary income tax rate, not the 25% cap. This can be significantly higher. For example, if an investor in the 37% federal tax bracket buys appliances and depreciates them, they'll owe recapture taxes at 37%, not 25%. This is why some sophisticated investors use cost segregation studies, a detailed engineering and accounting analysis that breaks down a property into components, roof, HVAC, flooring, etc., to accelerate depreciation on personal property while deferring it on real property. Cost segregation can save investors hundreds of thousands in taxes over time, but it also creates a larger depreciation recapture liability down the road. Let's address some strategies to mitigate depreciation recapture, because there are legitimate ways to reduce or defer this tax. Strategy 1. The 1031 exchange. The most popular strategy is the 1031 exchange, named after Section 1031 of the tax code. This allows you to sell one investment property and purchase another like-kind property without triggering depreciation recapture. The mechanics: you sell your property for $500,000. Instead of taking the money, you use a qualified intermediary to hold the funds. Within 45 days, you identify another investment property. Within 180 days, you close on that property. If you follow the rules precisely, you defer all depreciation recapture taxes and capital gains taxes. The catch: you must reinvest in a property of equal or greater value. If you sell for $500,000, you need to buy at least $500,000 of property, and you must complete the exchange within strict timelines. Case study, using 1031 exchange. Let's revisit Sarah. Instead of selling her duplex and keeping the proceeds, she could use a 1031 exchange to buy a larger apartment building or a commercial property. If she buys another $750,000 investment property or greater, she defers her $92,677 tax bill indefinitely. She also receives a stepped-up basis in the new property, which means the depreciation deductions restart. This is why many investors never actually pay depreciation recapture. They continuously 1031 exchange into larger properties, deferring taxes until death when heirs receive a stepped-up basis. Strategy 2. Installment sales. Another approach is an installment sale, where the buyer pays you over multiple years. This spreads your depreciation recapture tax across multiple tax years, potentially keeping you in a lower tax bracket and reducing your overall tax liability. Strategy 3. Partial gifting. If you have heirs you want to benefit, you can gift the property before sale. The heirs receive a stepped-up basis, the property's value at your death or at the time of gift, which eliminates the depreciation recapture liability for them. However, each of these strategies has limits and complications, which is why working with a tax professional is crucial. Here's an important counter-argument we need to address. Is depreciation recapture actually bad? Some investors argue that depreciation recapture, while painful, is still worth taking the deductions. Here's the logic. Let's say you take $109,090 in depreciation deductions over 10 years, saving you $30,000-$40,000 in taxes during ownership, depending on your bracket. You invest that tax savings into a down payment on another property or into the business. That money is working for you, earning returns. When you sell, yes, you owe $27,272.50 in recapture taxes, but you've had 10 years of tax savings and reinvestment. The math often still works in your favor. However, this argument breaks down if 1. You're in a low tax bracket during ownership, but a high tax bracket at sale. 2. You inherit the property, the step-up basis eliminates the recapture anyway. 3. You die before selling, same outcome. 4. You use 1031 exchanges, you defer indefinitely. So while depreciation recapture is theoretically not a bad thing, it absolutely should be planned for, not ignored. Let's talk about the emotional and financial impact of being unprepared for depreciation recapture. Many investors experience what I call depreciation recapture shock at the closing table. They negotiate a sale, agree on price, and suddenly realize they owe an unexpected $30,000-$100,000 plus in taxes. This can 1. Prevent deals from closing, they can't afford the tax bill. 2. Force them to negotiate a lower sale price, reducing profit. 3. Create financial strain, needing to borrow money to pay taxes. 4. Result in missed opportunities, not having capital for reinvestment. One investor I know personally held a $2M commercial property that appreciated $800K. She was planning to use the profits to buy 2 smaller properties, but her depreciation recapture tax was $187,000. She'd taken roughly $750K in deductions over 15 years. This unexpectedly reduced her available capital, forcing her to buy only 1 property instead of 2. This is why planning is essential. Let's summarize the key takeaways. 1. Depreciation recapture is not optional, it's automatic when you sell. 2. It applies regardless of whether your property appreciated or depreciated. 3. The tax is calculated as accumulated depreciation times tax rate, up to 25%. 4. You should budget for 25-40% of your profit going to taxes, including capital gains and state taxes. 5. You can mitigate recapture through 1031 exchanges, installment sales, or